Despite tough economic conditions, which are normal in cyclical industries, our guest tonight believes there are many reasons for investing in resources. Kobus Nell, Resource Analyst at Stanlib, is a high-conviction investor and joins us in studio to share his reasons for investing in the sector. Can we start with current news flow and your thoughts on Glencore Xstrata? Where are we going on this one?
Yeah, the deal is a little bit sweeter now. I think ultimately, for us maybe as South African investors, if this deal can be concluded, it would open, I think, a lot of possibilities with regards to Anglo-American and potential unlock, potential corporate activity within Anglo-American on some of its assets. I think that's the important point to note. Xstrata is a company which you got to say its assets is probably not tier one. It's probably not the best around. Its numbers. So it's a kind of a stock that do well in a bull market. When commodity prices are expanding and margins are opening up. But when it gets tighter, like it is now, it is a company that sort of can feel the pain, and I guess they may be in an awkward position here. It's obviously on Glencore's side, I would love to have this on board. It gives us a different sort of a profile to their whole portfolio and to the entity. So it will be interesting to see how this develops.
Kobus, do you think this is almost describing the land that lies ahead of us, where you're going to see consolidation with a lot of the bigger miners, perhaps a little less investment in greenfield projects?
Yeah, I mean, there's definitely a potential where you see some of the smaller sort of so-called tier two companies, mining companies, are struggling in this environment. And and when there's distressed sellers, sometimes I'm sure there's always got companies that are got strong balance sheets that are much better off, that are waiting in the wings. It's a reality, I think, in the mining cycle. That these things do happen in good times. We kind of see that capacity gets opened up, and I don't want to say every man and his dog, but there's a lot of people that want to try and do something and open a business or a mine and expand. But I think in tougher times, you do see sort of that consolidation. Saying that, the one important thing I think is, we've seen over many years that there was huge consolidation, I think, in the mining space. If you go back and you look at, even 10, 15 years ago, how many mining companies there was. And now it's sort of consolidated. And I think the play maybe on Xstrata, Glencore, and potentially on Anglo-American could be to sort of break some of the stuff up and then trying to sort of spin them out and list them separately.
Well, in the last cycle, the big consolidation was BHP and Billiton, and that became the global giant for this phase of the cycle. And now I think we're coming full circle. So,
while we're on BHP, Anglo-American, let's touch on Anglo-American and your thoughts around the stock right now. You're going to have to remind me, because I think your view was one where we were offering cautious value, or was it cautious?
Yeah, it was cautious.
It wasn't about the value.
No. Look, I mean, I think that, the obvious thing that the investors put forward is they look at Anglo-America and they look at its unlisted portion. So if you strip out its holding in Kumba Iron Ore and Anglo Platinum, its current portfolio, unlisted portfolio, or the so-called rump, is trading at spot prices probably at the multiple price earnings multiple of below 5 times. Now, but I think it's very important if you sort of compare that unlisted part maybe with the earnings that a company like Billiton, BHP Billiton, generated since 2003. The relative earnings of Anglo-American's rump has actually performed much worse than a company like BHP Billiton has done. And that's why one can also see this this rump's rating in the market has also been discounted, So it's been assets that's been struggling for many years. We've seen costs as probably not being controlled as well as they should have, again. So
all those investors betting on huge upside potential from Anglo-American could be very sorry about their decision.
The problem, I think, at the moment is, and it does look attractive from many aspects. I think if you look at its price to book and you look at some of these other metrics, it looks very attractive. The problem is, I think if you go back, iron ore in 2002, it's sort of been 10% of its earnings. These days, it's 50% of its earnings. So there's a clear shift towards the concentration in iron ore. And I mean, the market is saying this earnings is clearly not sustainable. You know, what it's struggling to find out now is exactly where will these margins sort of stabilize? Where will, because we are now in a process, we are seeing those margins contracting. We are seeing earnings coming down, you know, forecasts in general. We heard today again, you know, from Australia, they're lowering their iron ore prices, you know, sort of forecast in terms of Chinese demand. So, you know, there's a couple of dynamics playing out at the moment. And I think when this do play out, you just got to be careful of what you see on face value and not necessarily extrapolate everything forward.
It sounds like you've got to be careful for value traps. And do you think that's potentially
it is
some
a
of the
potential?
pitfalls with
Absolutely.
Some of the stocks?
You know, it's definitely a potential. I think if you sort of look at a company like Anglo-American and you try and back out what does it, you know, what sort of margins is implied by the current share price, you sort of get to margins which is close to mean levels, you know, over the last, call it 14 years. Now, that doesn't scream value to me as an investor. It's not at, it definitely doesn't sit at extreme levels. And I think a lot has to do with the macro story, you know. China, steel demand in China, which relates through to iron ore earnings for these companies, are extremely important. And it's not so much just the growth rates in China that's important. It's also that steel intensity. How much of the growth will be driven by steel? That is important.
BHP Billiton in the same breath. Do you feel a little bit more positive about BHP
I think it is.
Billiton?
It's sort of the more defensive stock if you're going in a tough environment, you know. And, you know, I guess ultimately if you compare BHP Billiton with Anglo-American, on the one hand you've got platinum on Anglo-American, and on the other side petroleum on BHP Billiton. And that's those two main differences. And I pointed out earlier, you know, to the relative performance maybe of all these other assets, you know, on a relative basis, you sort of benchmark them to 100 or so, that one would say BHP Billiton has sort of performed better generally than Anglo-American.
How do you feel about the synopsis being put forward now by Kobus? Are you big into Anglo-American?
We hold both Anglo and Billiton. We are slightly underweight resources, but not dramatically so. But for a lot of the reasons, we do think that there's value, but the reason there's value is for the bigger global reason, macro drop, and there could be a long time for you to actually see that value come through. So we hold both of them. We're agnostic to which one's going to outperform in the next.
Platinum you spoke about within the Anglo-American stable. Generally, do you think that we haven't seen the bottom on platinum stocks?
Yeah. Look, I mean, the developments we are seeing in Europe is definitely not encouraging for these equities to, you know, to sort of
rebound or re-rate.
Rebound or get to a point where one say this is, you know, this is it. I guess the uncertainty around the environment is how bad will Europe end up to be. And once it's sort of in an environment where one can sort of look forward, what is the type of growth rate one will expect out of Europe? You know, I mean, it's extremely important for platinum specifically. And, you know, I think at the moment, you know, what we've seen in the news of late in terms of some capacity getting taken out of the market is probably a step in the right direction. You know, I think if you look back even to earlier 2000, you look at the growth rate in supply in platinum, yet the demand, industrial demand for platinum has sort of gone sideways. So, you know, maybe these guys in the very good times, very high margins, got a little bit overexcited, and there was probably a bit of overinvestment. And I think one got to see that playing out now. Now, obviously, it's extremely difficult situation where a lot of these bigger miners are, which, you know, which as a company, they're still doing reasonably well. And I'm saying reasonably well, they're still making positive cash flow.
Surely simple economics will come to fruition because they're going to constrain supply. Yeah. Demand will ultimately outweigh supply and the price will pick up.
Ultimately. But how long is the cycle? You know, and how long will it actually take for the supply side to restructure? That is the more important question.
I think coming back to the global environment, what are your views on the super cycle, and is it dead?
Yeah. Look, I mean, Chinese growth has slowed. I think if you look at the three sort of data numbers which they say got probably the most integrity is sort of the loan growth, it is the freight rail, and it's the power consumption. And on all those three, we've seen slowdowns. We've seen levels currently that's below trend levels, and growth rate in China is slowing. I mean, you can see also in a lot of those the trend is downwards. So we've seen the impact, I think, that Europe, firstly, is having on Chinese growth now. We are actually seeing proof that the world is not decoupled. You can't sort of, go in an environment where you say Europe is in shambles, and yet the Chinese will be able. I mean, they export roughly about 60% of their exports is destined for Europe from China, and so it is an extremely important market for the Chinese. And I think secondly, it's also important to note that if one sort of look back post the global financial crisis in 2008, a lot of the capital investment has sort of been brought forward. So we've actually seen a lot of the capital that would have been spent later has been brought forward, and property it makes out about 25% of global steel demand, Chinese property at the moment. So, if we've seen a massive front loading of that spending and a moderation in growth, sort of back maybe to sort of the trend growth levels of these companies, it is no surprise to sort of see some of the numbers getting softer. But, China, in our view, is still in an industrialization process, with some of the other developing countries.
So, Kobus, what should we be buying?
So I think at the moment, you gotta look maybe for some of the companies which got a fairly strong balance sheet, I would say firstly, and some of them, a company maybe like Exxaro, which is sort of protected from its coal side, given its contracts with government. It got mineral sands and sort of the Ti2 pigment or the
that
pigment.
Tronox relationship.
Yes, that they've basically the new Tronox listed now,
listed
and Exxaro is a materials beholder of that now at the moment. Some companies which got structural margin support, I would argue. Those are the ones that may look attractive. And as I said, even the platinum, prices or commodity prices, can get softer from here on. We could see them pulling back further on more negative news from Europe. These platinum stocks are probably moving into a territory where some people will say, what, how wrong can you actually get this? If I'm buying it here, guys that are prepared to invest through cycles, that's fine. And we as a long-term investor at Stanlib, we sort of look at these themes as well. But I think you also got to be particular when you pick companies out of those sectors that will be in a position to benefit when we do see that platinum price comes up again, i.e. the companies that are investing through the cycles.
Last question from you on the resource side. So Exxaro, there we go, is a hot stock.
We've discussed most of it, and just the gold stocks. What are your views there?
Yeah, look, I mean, I guess, it was sort of a very, very roller coaster ride. If one sort of since last year when we had this euphoria on gold, everyone just bought into gold. Then we had some signs that the US growth is improving. Everyone ran away from gold again. We heard the high-profile people in the world, the Paulsons and so on, selling some gold. And then we sort of starting to see better US data, but then, there was some question marks again, almost similar to what we've seen last year out of the US. So I think sustainable growth in the US is still questionable. I'm not sure if one can, I mean, the bond yield sitting close to 1.5%, the 10-year US bond yield tells you that all is not well in the US. And I think on that front is obviously supportive for gold prices and some of our equities which are highly leveraged.
Kobus, always a pleasure having you in studio. Kobus Nell, resource analyst at Stanlib.